Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. 2 weeks ago, Zacks.com customers were asked to respond to a survey and tell us their most pressing concerns about the economy and the stock market. Our panel responded to those concerns in last week's 3-part roundtable. In case you missed it, you want to check it out on the website. But there were also some more specific questions which were not able to be answered, but that we felt were just as important, and so we decided to have our panel weigh in on them this week in another marathon session, I'm afraid. And you know the panel members, but let's go through them once again. Steve Reitmeister, our editor-at-large at Zacks.com. Charles Rotbluck, our senior market analyst. And, of course, the maestro himself, Kevin Matris. So these are real customer concerns, real customer questions that we're going to be addressing this week. And I'm just going to start at the top and work our way down. We're not going to mention names, but these are, in fact, we can attest to the fact that these are real questions. Mm-hmm. So, Steve, let's throw the first one to you. Here's someone who says, I have a ton of paper losses. Should I get out or should I hold on?
I'm a little, I just got to hold up the thing that's the paper losses, which is something that some people believe is true, and some people, I would say, I'm a little leery about people thinking about them as paper losses. No, they're real losses.
And we've talked about that before.
I believe that if you had $200,000 and now you have $100,000, don't think to yourself you have $200,000. You have $100,000, which is fine. What the paper losses sometimes leads people to do is to hold on to bad stocks because they're trying to say to themselves, well, I'm just going to wait for it to come back to break even, then I'm going to sell it. Well, we've talked about this concept of the constant state of break even, which I'm saying is let's put away the past, let's put away our failings and things of that nature. If we got $100,000 left to our name, that's what we have. What's the best stocks? What's the best investments to put them in now? So what I'm saying is I just don't want this to paper over the fact that people might be in some bad stocks. And so as long as they're looking at their stocks soundly, stay in the ones that have the best earnings outlooks and things of that nature. And if not, let's rotate to something else.
All right. Charles, you agree with that?
I do, and I think it's really important that people continuously actively manage their portfolio, and that includes their mutual funds. Even though mutual funds are considered passive investments, you want to always make sure the mutual funds are still performing like you expect them to, keeping their expenses in line, and investing in the type of things you bought that mutual fund for. But I think one point I want to add to Steve is when you look at your stock, if you have some stocks in a taxable account and you're worried about selling it because you have to pay taxes, you really need to step back and ask yourself, would I better be able to make up those taxes I have to pay by buying a better stock that is more likely to appreciate in the future versus holding on to a stock right now simply because you don't want to pay taxes?
And going to someone who doesn't let emotion take a role in anything that he invests in. Kevin, what do you think?
I think one of the best questions somebody can ask themselves is if they weren't in that stock right now, would they buy it? If the answer is no, then you should sell that stock. If the answer is yes, but you actually still have a loss in that stock, if the answer is yes, I would buy that stock, then I think you need to ask yourself some hard-hitting questions, such as looking at your past trades. How right have you been in the past? Have you been right more often than you've been wrong? Also, too, looking at your past losses. In general, how large or small have they been? Also, too, would you have been better off selling them earlier? So these are questions that you need to be able to ask yourself. And also, too, you need to ask yourself, what would happen to your portfolio if the stock continues to go down and you're forced to sell because you just can't take any more losses? Because what's interesting is that, right now nobody wants to sell at the bottom because they're afraid of missing out on potential upside. But eventually people are forced to make a decision, whereas if it keeps going down, it's not about missing out on gains. It's now about making sure they don't have any more downside. So these are questions people have to ask themselves.
All right. Here's another good question. Why are stock prices plunging for companies that are fundamentally sound and earning money even in this economy? Charles, why don't we start with you on that one?
Sure. That's just typical of a bear market. You see people have an aversion to stocks, and they're not really asking themselves, is this a good stock or is this a bad stock? They're just trying to get out. Now, the problem gets amplified as you have people actually selling their mutual funds because they get scared by the markets, and that causes some of the professionals to sell. And I want to point out that when people look at the market, realize mutual funds are always at a lagging indicator because people sometimes won't start selling their mutual funds until they see their statement, which is right about now for a lot of people getting their statements for the third quarter. So you have that lag. But I think you really just had a big aversion. And some of it actually is based. When we look at earnings estimates for 2009, we are seeing more estimates cut than being raised. The caveat to that, however, is typically the last month of a calendar quarter, we see fewer revisions overall. And that's because analysts are kind of comfortable with what they have, or they don't feel like they have enough information to really say, okay, the company's going to earn this for the next few quarters. So as we start seeing earnings coming in there, we're going to see the mix change and probably see some positive revisions for some of your more sound companies. But right now you just have a bunch of negative influences affecting the markets at once, and that's why you're seeing this drop. And that's why a lot of contrarians actually like to buy in fear environments, because you do have good stocks that are sold down for really no rational reason.
Kevin, I think you even did a screen on this or something that related to this
Right.
A week or so ago, didn't you?
Yeah, I think really there's two things people need to keep in mind. First, I believe that everybody should be cognizant of the fact that in bear markets, approximately 70% of the stocks go down, and there will be many instances where it's even worse than that. I think when the economy slows, people are trying to determine what they're going to be willing to pay for future growth. And when the economy is growing very briskly, people are willing to pay up for future growth, and that's when you see an increase in PEs, multiple expansion. When you have a slowing economy or contracting economy or a crisis like we're going through right now, people are unwilling to pay for future growth because of all of the uncertainty. They're uncertain about the economy, and they're uncertain about how that's going to affect the company they are in. So you see the selling and the repricing of assets, but then you also have the emotional aspect, grip everybody. They see a red in some of their crummier stocks, if you will, but they also see their good stocks going down as well, and they start selling those too, further exacerbating the decline. So I can understand why people are somewhat concerned and wondering, how come these stocks are going down? But sometimes that just happens. But I believe that the really good fundamental companies, those are going to be the ones that are going to respond quicker and probably the best.
When people say, why do fundamentally sound companies go down, I think what they're making is a slight confusion of what fundamentally sound means. What they're doing is they're taking a look at the past earnings for a firm, and usually they're talking about the large cap blue chip stocks, and they're saying, look how great these earnings are. But really, the market looks forward. And when you have an event like a financial crisis, and knowing that there is going to be a weaker economy in the future and therefore lower earnings in the future, that some of that sell-off is because even the best companies, even the Johnson & Johnsons, and the General Electrics, they will be seeing lower earnings in their future. Here, how much lower, that's to be determined. But the thing is, the market is appropriately reacting to future earnings, which is, again, fundamentally sound in our book, is about the prospects for the future. And everyone's futures has been dimmed a little bit given the economic news that we've had over the last few weeks.
All right, we're going to take a couple more here, and we're going to kind of go through them quickly for time. How long should I wait before getting back in the market, Kevin?
This is an individual decision that each person needs to make based on their own risk tolerance. And I believe, though, that we are closer to the bottom than not. But I did a study in prep for today's roundtable, and I have found that the market has decreased over 44.4% from the highs from last October. This is where we are right now. But I then went on and I wanted to see the average decline of the 10 worst bear markets from 1929 to present is roughly 42.8%. So this puts us, within the historical range of the average bear market decline. What's also interesting to note, though, is that within a year's time, the market has come back on average of 55.2%. So I think starting to snap up good companies right now and starting to figure out what your dream portfolio could look like, I think now is the appropriate time to start looking at this.
Charles.
One of the things I think it's important for investors to realize is they can get back into the market, but not bet everything. Say, for instance, you typically put $10,000 into a particular stock. Dollar cost average, put $1,000 or $2,000 in now, $1,000 or $2,000 in next month, and slowly build up your position. You don't have to put everything in right now. But as far as when to get back in, I'm starting to add stocks back into our Zacks Elite focus list. I'm doing it slowly. I'm not adding a ton of stocks at once, but we added a few last week, hopefully add a few this week, and gradually go on. So people have to realize that, yes, you can get back in the market, but getting back in the market doesn't necessarily mean spending all your cash right now if you've been on the sidelines.
Okay, Steve.
Yeah, it all depends on your time horizon. Okay, and I mean the time horizon, whether you're a trader, you're trying to make short-term activities, or you're trying to invest for the next 3, 5, 10 years. Let's start off with a long-term investor. What Kevin is saying is the odds are clearly on the sides of the long-term investors at this point. Is there a little more downside? Yeah, probably. But the thing is, looking out a year, 2 years, 3 years, 5 years, history is clearly on the side of investors that there will be a nice snapback in stocks, and that's what Warren Buffett has been talking about, that he's getting back in the market now. If you're a trader and you're trying to perfectly time the bottom, good luck. Okay, I mean, seriously, and that's the problem here. So if you're a long-term investor and you're trying to perfectly time the bottom, stop it. Okay, you're not. You're not going to do it. Okay, if you've been completely out of the market, congratulations to you for getting out of some of this mess. But yes, do start adding into good companies at this time over the next year, and you will be very happy where you are 2, 3 years down the road. I have no doubt about it.
All right, quickly, I need a number from each of you, not a litany at this point, because we're coming up short on time. Okay. How low can it go, Steve, on the Dow?
The lowest number I can imagine for the Dow would be 7,000, give or take, which is approximately half of what it was at its peak in October. The reason why I'm picking that, because I believe there are decent parallels with the mid-70s when the market had that same downside move, and that's why I'm picking that number.
Charles, number not a litany.
I think the October 10th intraday low of 77.73 was the low. We've rarely traded below 7,300 in the last 10 years, but understand we're still trading at a little over 11 times earnings for the Dow. If we look at a scenario where we fall to single-digit PE ratios, which has happened, it has not happened since 1985, but if that were to happen, we could be looking at a scenario of 58 to 6,300 for the Dow. But I think that's a worst-case scenario, and I do not envision it happening.
Kevin?
I would like to believe the lows are in, but if we were to see lower lows, I would go back to the 2002 low at 71.97. That puts us at about 49.3% decline, pretty close to what Steve is saying.
There you have it, real answers to your real questions on this edition of The Roundtable with the whole crew. I'm Terry Ruffalo.